Every winning investor knows one truth: markets move in trends. The problem is, most people don't know how to identify them, and they end up buying high and selling low. I'm Barry, a financial technician, and today I'm going to walk you through 5 keys to mastering trend analysis. By the end, you'll know how to spot whether a stock is heading up, down, or sideways, and more importantly, what that means for your money. The first key is to understand timeframes. Trends exist across 3 distinct time horizons. Short-term trends usually last for a few days to a few weeks. They are often triggered by short-term events such as quarterly earnings announcements, product launches, or breaking news. These trends are fast, volatile, and are usually the domain of active traders. Medium-term trends typically last from a few weeks to a few months. They capture larger movements in price and are often influenced by economic indicators, industry shifts, or broad changes in investor sentiment. Swing traders and position traders often focus on these because they provide bigger opportunities than short-term noise. Finally, there are long-term trends. These can last for months or even years. They are shaped by powerful forces such as demographic changes, global economic cycles, or technological revolutions. Long-term investors rely on these major trends to build wealth over time. The important lesson is this: a stock can be falling in the short term while still being in a powerful long-term uptrend. If you only focus on one time frame, you risk being completely out of sync with the market. The second key is to recognize direction. Every trend has a direction, and there are only 3 possibilities. First, an uptrend. This is when prices consistently form higher highs and higher lows. Investors are optimistic, demand is strong, and momentum carries the stock upward. Uptrends are often supported by good earnings, positive economic indicators, or strong industry conditions. Second, a downtrend. This is when prices form lower highs and lower lows. Fear dominates, investors are selling, and confidence is low. Downtrends can be triggered by poor financial results, rising interest rates, recessions, or any negative catalyst. Third, consolidation, also called a sideways trend. This is when prices move within a defined range without making significant new highs or lows. It usually happens when the market is waiting for a new catalyst. Consolidation is sometimes called the calm before the storm, because once the range breaks, prices can move sharply in either direction. Each of these directions tells you something about investor psychology. Optimism drives uptrends, fear drives downtrends, and uncertainty drives consolidations. As an investor, knowing the direction of the market is essential before making any decision. The third key is to combine time frame with direction. This is where analysis becomes powerful. For example, during the COVID crash in early 2020, the market entered a sharp, short-term downtrend. Prices fell very quickly and fear dominated. But when stimulus programs and recovery began, the market moved into a strong, long-term uptrend that lasted for years. Inside that broader uptrend, however, there were multiple medium-term corrections, where prices pulled back for weeks or months before resuming the larger trend. By combining time frame and direction, you gain perspective. If you only look at short-term moves, you might panic and sell during a healthy pullback. But if you see that the long-term trend is still strong, you can hold your position with confidence. On the other hand, if both the short-term and long-term trends are negative, that is a strong warning signal. This layered view helps you stay on the right side of the market. The fourth key is to use moving averages. Moving averages are one of the simplest and most effective tools for identifying trends, and they are used by professional traders all over the world. I recommend using 3 moving averages together: the 20-day moving average for short-term trends, the 100-day moving average for medium-term trends, and the 200-day moving average for long-term trends. Here is how they work. If the price is above the moving average, that usually signals strength and an uptrend. If the price is below, that is weakness and a downtrend. If the price keeps crossing above and below, that means the stock is consolidating. For example, when a stock trades above its 200-day moving average, it is considered to be in a long-term uptrend. When it trades below, it is in a long-term downtrend. Many large institutions and professional funds use this signal to decide when to buy or sell. The fifth key is learning to scan for trends. You do not need to check every stock manually. Modern charting platforms such as TradingView allow you to filter and scan thousands of stocks instantly. You can filter for stocks trading above their 50-day or 100-day moving averages, or for those making new 52-week highs. This will quickly show you which stocks are in strong uptrends. You can also scan for stocks hitting new lows if you are looking for downtrend opportunities. This process gives you an immediate watch list of trending stocks. Instead of reacting to news headlines or tips, you are proactively focusing on the stocks with the strongest momentum. This is exactly how professional traders operate. They prepare their lists in advance so they are never caught off guard. If you want to try these tools yourself, I've included my top recommendations in the description below, with exclusive discounts and free trials for my viewers. If you found this helpful, hit like, subscribe, and check out those links. Thanks for watching, and I'll see you in the next video.